Your $10,000 is slowly shrinking, but not because the stock market crashed, but because daily living is getting more expensive. Groceries, eating out, transport. So, how do smart investors fight back? I'm Joanna, co founder of The Smart Investor. So, let's have a chat with my fellow co founder, David Guo. So, David, the cost of your daily cup of tea, your teh is going up. I start off with a fixed amount thinking that it will be good for retirement or thinking it will be good for my budget, will be good for daily expenses. But increasingly, it is not getting enough. So, what should investors do?
Joanna, you were talking earlier on about inflation at 2%,
Yes.
and you have $10,000 in the bank, and you think, oh, that's quite adequate for me, 10,000. It's a kind of buffer for myself. But at 2% inflation, your $10,000 in 10 years' time would only buy you $8,000 worth of goods. And that's if inflation remains at 2%. If inflation is at 4%, it means that your $10,000 will only be worth around to the 6,600. So that is the danger of inflation. It just eats away at your money unless you do something with it. And tea. I remember when I was buying a cup of tea for 20 cents. Yeah. Well, forget that now. Yeah. It's more like $2. That is what inflation is. So inflation is just shrinking the buying power of your money unless you can do something with that cash in order to allow it to keep pace with rising prices. And there are probably only a couple of investments that you can make that will be able to do that. Cash will not do that. Yeah. Bonds generally don't do that either. So you're only left with two: property and shares. I mean, those are the asset classes that will allow you to invest your money and let it grow over time. And not many people can afford to go out and buy $1 million condo overnight. It is very difficult to do. And your $10,000 won't be able to even buy a window.
You'll be hard pressed, I think, to find a condo for $1 million these days.
Precisely. And so your $10,000 might seem like something that is quite comfortable for you, but it will just whittle away unless you do something with it. And one of the best things that you can do is to invest that money into shares. It might seem risky. You think, oh, I put $10,000 into shares and the stock market could fall tomorrow and my $10,000 could suddenly become $8,000. Isn't that bad? Well, the stock market does do things like that. It does crazy things. But over the long term, you would expect an investment in the stock market to generate, well, to grow at somewhere between 6 and 8%. And that is a lot better than having your money shrink at between 2 and 4%.
Okay, and also we always say that don't invest the money that you need in the next 5 years.
Correct.
Right? So, and that allows us with a comfortable buffer, I would say, to let that money grow at the 6 or 8% that you're talking about. Okay, so 6 or 8%. Let's talk about dividends.
Yeah.
And how does that work into the picture?
Okay, right. Your 6 or 8% is your total return. In other words, it is the share price going up and also the dividends that you are collecting from your investment. Which is why I prefer to invest in income-paying shares. Some people say, oh, what's the point in investing if it's only going to pay me a 2% dividend yield? Why should I even bother? Well, the beauty is that the 2% income that you collect from your investments, you can do with whatever you want. You can use the money to defray some of the costs that you have in your housekeeping budget. Or if you really don't need the money, you can just plow that money back into your investment, and then your investment will just gradually grow over time. You'll be surprised at how just something simple like 2% dividends added to your investment will be able to grow the number of shares that you have. The number of shares that you then have will be able to pay you more dividends. Those dividends you put back into the investment again, and that grows again. So it's almost like a kind of snowball. I know, this is not the right time to talk about snowballs in Singapore because we don't have
out there is awful.
because we don't have snow. But if you go to a country where kids play with snow, they take a snowball and they roll it in the snow And that snowball just becomes bigger and bigger and bigger until you have such a large snowball, you can build a snowman out of it. And that really is what compounding and what income investing is all about. You don't have to do all the heavy lifting yourself. The heavy lifting is done by the company by paying you the dividends.
And you know, you talked about 2% dividend, but I know for a fact that you own the shares of so many companies that pay a much higher dividend yield. I've heard of some of your companies going about 5, 6, 7, 8, 9%.
Correct.
Right? So maybe if we could talk about some of the companies, okay, then if we're talking about 8, 9% versus say a 2%, should we worry when it's too high versus a dividend yield that is so low? Or does it mean that a higher dividend yield just allows your snowball to grow at a faster rate?
Okay, you know, Joanna, I love to cook, right?
Yes.
And the beauty of cooking is that you can balance the dish at the very end in order to give you the right kind of flavors. By that, I mean, if it's too salty, too sour, too sweet, too spicy, you can adjust that kind of flavoring. Now, if you only invest in shares that pay you a very large dividend, those shares aren't going to grow an awful lot. So in exchange for the big dividends that you're collecting, the big dividend checks that arrive in your trading account, you are not going to get a great deal of growth. But what you need in a portfolio is the right balance of growth. In other words, the portfolio must grow in value, and it also must at the same time generate the kind of income that you require. And that is what we do when we talk about portfolio management. We're trying to get the right balance between the income that we desperately need in order to plow back into the portfolio again and the capital growth. And that is what the 8% is made up of. And so if you do it right, you should be able to grow your dividends at a very fast rate, whilst at the same time grow your portfolio. And the kind of targets we're looking at is somewhere around about sort of 8 to 10%. That is a lot better than having your money shrink at 2%. But just beware that stock markets are very volatile, or they can be very volatile, which means that there could be times when you go, oh my goodness, what have I done? And at other times you go, wow, am I so clever? But if you balance out the whole thing, you will find that you should have a reasonable investment that will grow over time, that will give you everything that you possibly wanted.
So back to inflation, David. Instead of letting my $10,000 become $8,000, $6,000, how can we as investors invest in the companies that are not just collecting $5 from me anymore, they're collecting $6, $7, $8, $9, $10 from me as a consumer?
Okay, well, you got to look at those companies and ask yourself why they are able to pass on that price increase to you. Is it because they have a unique selling proposition? Is it because they have a product that will be able to withstand those price increases? And if you identify those kind of companies, then those are the kind of companies that you want to invest in. Pricing power is one of the most powerful attributes that any company can possibly have. A company that can increase its price. I mean, you and I know that there are some things that we enjoy eating, say curry puff, right? I mean, if a company that sells a curry puff and it can increase its price in line with inflation, and you are still going out and buying that product, then it means that it has got pricing power. And the fact that you continue to want to buy that product means that that company is going to do well. That company has got the right recipe for success. And it doesn't just rest with curry puffs. It rests with other kind of things that we need on a daily basis. Some people say that, you know, what happens when you get inflation is that people will start cutting back on their spending.
That's right.
That's not true. I mean, if you have a look at some of the personal care goods companies out there, and by that I'm talking about companies that make shampoo, companies that make soap, companies that make deodorants.
You're talking about the P&Gs and the...
We are talking about those kind of companies, the Unilevers, the Procter & Gambles, the Reckitt Benckiser's. Just because there is inflation out there, hopefully doesn't mean that you're going to take one shower less every day, right? Okay, it doesn't mean that you're going to wash your hair any less. It doesn't mean that you're going to wash your clothes any less.
Yes.
You are still going to continue to buy those kind of products. And those are the kind of companies that, as I said, have pricing power. They can tap into the psychology of the consumer, and they know that, well, if you can't afford a big bag of soap powder, what they do is they shrink the size of the soap powder so that it becomes easier on your pockets. But what they're also doing at the same time is to pass on that price increase to you. It makes you feel a little bit more comfortable going out, not spending a huge amount of money, spending a little bit less, but at least you are still continuing to buy. And that is another sign of pricing power. It's very, very powerful. And it is something that you innately know. You know inside yourself that, hey, this is costing a little bit more, but it doesn't stop you from buying it.
And that's why we also see how the malls out there are so crowded. Is that the same logic?
Well, quite right. And if you think that the shopping malls are doing okay, then have a look at some of those real estate investment trusts. One thing that I was taught when I was quite young was my dad telling me, wherever you go, whatever you are looking at, let's say it's a teacup, turn over the teacup and see who makes that particular teacup. And that is something that I've learned over time, that when you go into the shops, have a look at the products that you're buying. It isn't just soap powder. It is soap powder made by a company. Drill down and have a look and say, oh, Unilever, oh, Procter & Gamble, oh, Reckitt Benckiser. And then go back and have a look at those companies' fundamentals. And then have a look and say, are the sales growing? Is revenue rising year after year after year? Is profit growing? Is there cash flow? And then have a look at the dividends. Are they increasing their dividends every year? And that is how I got started in investing, by having a look at companies. A phone isn't just a phone, it's an iPhone, right? Why does Apple have the ability to charge people $1,000 for a phone, whereas the first phone that I ever bought probably only cost me a couple of $100? And yet now I go, oh, I need to buy a new phone. $1,000? Why is it able to do that? Because it knows what the consumer wants, and it's giving what the consumer wants at a price, and that will enable them to increase their revenues, increase their profits, and also pay a dividend. And that goes throughout everything that I do all the time. I look at things. I know it sounds boring, but wherever I go, I do look at companies and I do look at who makes them and whether or not it is a good investment.
I personally like to go to the shopping malls. They are owned by some of the biggest REITs in Singapore here. And I always like to go and see, oh my goodness, look at how crowded it is.
Yeah.
And then I feel good about my investment in a particular REIT. Is that the same logic?
It is. And are you as boring as me, where sometimes I go at the same time every day on a particular day of the week and sit down and just count how many people are going around? I look at footfalls, right? So I find somewhere comfortable to sit and I go, right, how many people are walking through this mall at the time? And are there more people now than there were this time last week, the week before? And some people say, that is going over the top. But it gives me a feel about whether or not that REIT is worthwhile investing in. It's called walking the shop floor.
Literally, quite literally.
Yeah, and it is quite enjoyable to do sometimes. Go into a restaurant and see how busy they are.
Yep.
Go and have a look at some of your fast food restaurants, such as McDonald's, Tim Hortons. Go and have a look. Have a look at Starbucks and just see how busy they are. And that gives you a feel about companies and how they operate. And it is a fascinating field to actually be involved in. But I'm glad I'm an investor.
Well, even if you're at home and watching Netflix, you're not hitting up.
Netflix is another company that you could possibly invest in. And then have a look at the companies that make the movies that you are watching, and drill into those companies and see whether or not they are a good investment.
Okay, thank you, David.
You're welcome.
So, when inflation hits, smart investors don't cut their expenses, but look for new sources of income. If you like that, follow us for more smart investing tips.